Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Michael Edesess. How you doing today, Michael?
Just fine. How are you?
Good, good. Well, glad to have you here. Really excited to have Michael on the show. He's a wealth of wisdom and has a very deep math background, which I'm envious of. I love people who are good at math because that's what runs the world. So, Michael, maybe you could tell us a little bit about your background.
Okay, so without going into too much of it, I'll just state what's relevant for this. So, well, okay, I got a high level education, so to speak. I went to MIT and majored in philosophy and mathematics. Started graduate school in philosophy for some reason, but found that that wasn't going to work, so I switched into math. Got a PhD in pure mathematics, which is not the same as applied mathematics. There was an applied math department at the university, and there was no communication between the pure math and applied math because pure math was regarded itself as kind of above it all, just like an art form. Anyway, but nevertheless, it's you can use it.
Uh,
Yeah,
yeah, I
so
was going to say,
so
how'd you get started in finance?
well, okay, so after getting my PhD, I didn't know what I was going to do. Actually I had been quite very active for a couple of years, the early years in the uh, movement against the Vietnam War, and this made me a little bit uncomfortable about trying to get a job with a technology firm because they were all making weaponry and that sort of thing, and a guy I knew in my class said, "Oh, you ought to try this brokerage firm. He said they're doing interesting things with mathematics." I'll never forget that because I'd like to strangle him. But it turns out he died. I looked him up recently. Um, anyway, so I went to that firm. I didn't know what finance was. I didn't know what I thought it had to do with stocks and bonds. I didn't know what they were. They interviewed me. They said, "Okay, you're hired." I said, "Well, all right." I probably should have thought about it a little more than I did, but I just figured, okay, I'll take the job. So I worked in a finance firm. It was a brokerage firm that's gone. It was sold off in pieces to other firms a few years after I left, but it was regarded as one of the most sophisticated uh, firms in the field. I worked there a few years, but I just hated it. I just thought it was sort of disgusting. The you know basically. So finally, I quit, and I wound up. Well, I worked briefly with a partnership, still in finance, but that was also I couldn't stand that either. So I wound up just chucking the whole field, and I went to work at what's now called the National Renewable Energy Laboratory in Colorado, which was great for a while, but didn't pay much, I can tell you that. Um,
So,
I,
so tell us a little bit about, your experience in the finance field. I know we talked about it a little bit before the show, but there's a bunch of parts of it that you've kind of pointed out. I mean, we talk about it a lot in the show about, I mean, we call them investing half-truths that the industry typically parrots, but they're not necessarily accurate. So maybe you can tell us a bit about some of the ones that, we talked about. I know you mentioned things like rebalancing. It's one of those things that the industry really kind of shuttles as being a fact, and everyone just takes it as fact, and nobody bothers to assess it. Maybe you can tell us a little about why you think that's untrue.
Well, it's not clear what purpose it's supposed to serve. It's often implied that it improves your investment return, but it doesn't. There's no either mathematical or evidentiary reason to think it improves your investment return. In fact, it is very likely to give you a lower return on investment than if you don't rebalance, let's say between stocks and bonds. So if you decide you're going to, for whatever reason, that you're going to invest 60% in stocks and 40% in bonds, because stocks tend to perform over time better than bonds, after a while, you'll have maybe 65 or 70% in stocks. And the advice is always, well, you should rebalance back to the 60-40 that you started with. Well, there's simply no reason to do that. The reasons that are given are usually just wrong, or kind of like six of one and half a dozen of another. Okay, you might as well do this. Why not? I mean, everything you do is arbitrary, so you might as well rebalance. But there's no reason for it, no theoretical reason, and no reason based on evidence to do it. There are
So,
reasons if you want to. There are reasons to either rebalance or to simply buy and hold, depending on what your objectives are. But there's no overriding reason to rebalance.
so I don't understand why they would promote that. You're saying it's untrue. I mean, logically, it seems to make sense if you're buy low and sell high. I mean, why wouldn't that work?
People confuse the past with the future. You're talking about buying low relative to the past price, but you don't know what the future price is going to be. You want to buy low relative to the future price, and you don't know what that's going to be. And there's no evidence that anybody knows what it's going to be. And it's against the theory. All of the mathematical theory of investment says you don't know what the future price will be, and it's just as likely to be higher than the price that you bought at because it was lower than the last price as it is to be lower. So there's just no theoretical reason to do that. And as I say, there's no evidentiary reason to do it either.
So
It
you're
does not it does not buy low and sell high relative to the future price.
okay. So what you're saying is it's not that it's wrong. There's just no reason to do it one way or the other.
Yeah, it's wrong to say that it improves your return on investment. That's what's wrong.
Okay. All right. So it's not a bad thing. It's just it's not what it's all cracked up to be, kind of a
That's
thing.
not bad. It's not
Okay.
bad.
Now,
Mhm.
what about diversification? Because I know that's one of those one of those things that Wall Street holds as true. And my understanding was it all started from an academic research paper that Wall Street took and decided to sell it as a way to basically get more money into mutual funds. That was my understanding of how it all started. It wasn't because it worked; it was because it was just a better way to sell mutual funds. So, can you tell us a little bit about how that works and how that's applied to Wall Street?
Yeah, it started with Harry Markowitz's paper in 1952, so it's more than 70 years old. He only recently died. Um, he got a Nobel Prize for that paper, and it's true. Diversification, rather than buy only one or two stocks, which is very risky because they could be the wrong ones. You're much better off to buy 30, 50, 100, 500, 1,000. Um, Once you get up to 30, 50, 1,000, it doesn't make that much difference anymore. But you're much better off to diversify by buying a lot of stocks than just a few. Now, that applies to stocks, but people get very confused about diversification, and Wall Street takes advantage of this confusion by saying, well, you need to diversify by buying several mutual funds. Well, that's not true because one mutual fund, for example, a total market index fund, is just as diversified as you can possibly get. You won't diversify further by buying another mutual fund. It won't help you at all. Diversification is a very simple idea. It can be done very simply, and it's true. It does um, reduce the risk of holding stocks or any other investment for that matter.
So then why would I mean, I know that's always the rationale for indexing, right? Because you can't
Hmm.
pick which ones are just index. And I know some people are very in favor of that, but then you've got people like Warren Buffett who are clearly not indexing, and he does a great job. So,
He's in
how do you
favor
square
of
that
it. He is in favor of indexing. He
for other
always
people,
says for
not for himself?
well, he's already not doing that. I mean, he doesn't pick stocks. He hasn't picked stocks uh, since the 60s. He buys companies. He buys pieces of companies. That's not picking stocks.
It's
And
kind
he
of the same thing, though,
recommends,
isn't it? Buying stocks is a part of a company.
yeah, okay, it's similar, yes, but he doesn't, well, at any rate. Um, but he does recommend index funds, not just for most investors, but for all investors. Now, he doesn't do it because he does other things. I mean, he does what he does. And what should he do? Sell all those companies and put all the money in index funds? It, it's
Well, yeah,
it's
right.
not
I mean,
it's not
he bought Apple. I mean, his company's bought a bunch of shares of Apple recently, and he's bought a bunch of other companies. He buys and sells. I mean, his company does. I don't know if it's him, but it doesn't really matter.
yeah,
They're still buying individual stocks. They're not taking the proceeds and putting it into the index.
yeah. But incidentally, are you aware that his fund, which is Berkshire Hathaway, has for quite a few years now underperformed
Hmm.
the market index. So, but I wouldn't, I mean, I still have a very high regard for him because of his wisdom, and I don't a high regard for somebody doesn't depend on their stock market performance. In his case, there are many other reasons to have a very high regard for him.
Agreed. I guess, I mean, also, he's kind of gone against his own investing philosophy as well. He was always for investing in companies that are not capital intensive. And what has he bought in the last like 10, 20 years? A bunch of oil companies, and railroads.
Yeah.
Those are highly capital intensive businesses. And I would argue his underperformance is large part due to that. I mean,
Well, I don't know. I don't know. It's not my, I haven't tried to
yeah.
track his business, so I don't know.
So let me ask you this. So you'd also mentioned before the show about mean variance optimization and your opinions on that. Can you first explain what that is, and then kind of how that's being applied to Wall Street and what you think is, why that's shouldn't be?
Yeah. So this was the first installment of what is now generally referred to as MPT or modern portfolio theory, and this is Harry Markowitz's paper in 1952. And it says not only that it's better to diversify, what it says is that the degree of fluctuation of your portfolio value becomes less if you diversify, but it doesn't reduce your expectation of return on investment. So if you buy one stock, you might have an expectation that it's going to earn, let's say, 7% a year. Let's say that you think that all stocks are going to earn 7% a year. If you if you buy only one, it might earn 7% a year for some number of years, but it might also crash and become worthless. But it might also become worth 100 times as much or 1,000, or in the case of Microsoft, 5,000. I have a reason for saying 50,000. I have a reason for saying that, but anyway. Um, uh, so he said better not to buy one stock. because you have the risk that it will go down a lot. But if you buy a number of stocks, all of which have an expectation of a 7% return, it's much more likely that you'll get that 7% return or something close to it. Whereas if you only buy one, it may be likely that you'll get the 7% return, but it's also very likely that you'll get something either much worse or much better. So this is the reason for diversifying. But he went on beyond that to say that if you buy just exactly the right portfolio, you can minimize that variation or uncertainty of return in theory. And then he did the math to show how you would optimize that. Now, the trouble with a general problem with the finance field is that they think that you can take a piece of theory with a formula and immediately apply it. But in order to apply it, in the case of Markowitz's formula, when they first tried to apply it, they tried to apply it by optimizing a portfolio of all the stocks on the stock market, which were about 6,000 at that time. In order to run Markowitz's formula, you need to input into it millions of inputs because it requires as inputs expected returns, variances, and correlations. Now, there's no way to reasonably estimate those inputs. You have to just kind of arbitrarily put them in. So when they first did this, what they did was they estimated some inputs from past data. And when they ran the model, it came out with exactly the opposite of what it was supposed to do. It would wind up recommending that you put all your money in one stock or two stocks because one of them might have an outlandish expected return based on past data. So you can't really run that model without jiggering the input to make the output come out the way you think it ought to. And yet this model is supposedly used all the time, but whenever it's used in that way. The input is designed, it's by trial and error, or when I did this, I derived it by theoretical means. It's derived, it's input in such a way as to make the recommended allocations come out the way you want them to. So the model is not really used at all. It's just they pretend to use it.
Interesting. So it sounds to me like the whole thing is just a sham, is what
It's
you're
a
saying.
sham. It's a sham. The whole thing.
Hmm.
The whole thing about modern portfolio theory is just a sham.
Hmm. That's interesting. So why do you think it is that Wall Street is not calling this out? I mean, there are plenty of
They
really
make
smart
money.
math people.
They make a lot of money on it, and you sort of get used to it. I mean, I wondered what's going on here. I came in as an outsider, and everybody seemed to take this seriously. And they were talking as if they were talking about math, but it was lousy math. I wondered, I mean, do they want to be mathematicians or what? I told this to a fellow graduate student, I said, do these people want to be mathematicians? If that's what they want, they're going to have to do a lot better math. Or do they want to apply it for practical purpose? But if that's what they want to do, that this doesn't apply to what they're trying to apply it to. It just doesn't help. It doesn't fit. It's not applied correctly. It's just not useful. So, but they get used to it. This is their job. You can converse once you get used to the lingo. You can converse with other people about it. You can, as I say, when these people get together for a beer after work, there, somebody will say, of course, it's all BS. And everybody will say, yeah, 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 okay. And then but that's that's the end of that. It's quite rare that somebody like I did says I can't stand this. I thought I wanted to do something meaningful in my work, and this is not meaningful.
It makes me kind of wonder because I mean that was really the premise for 2008. The crash was, no one was paying attention. I mean, this stuff was happening. It was easy to figure out. I did know people prior to that in 2007 who were aware of what was going on. And
Mhm.
but there weren't many. Most people were asleep or maybe they were just willfully ignorant. I don't know. I mean,
Yeah.
what do you get a sense? Is it mostly just people who are just like, yep, I know it's BS and going along with it, or is it just people just aren't paying attention?
In that particular case, and I've seen this done in other cases in my experience, because I mean, since I quit the field and went to work in the solar energy research area, uh, to make enough money, I went back, uh, created a couple of computer programs which paid. I did some consulting on the mathematics for some kind of high level companies. And I've seen what they do. If you bring up something that, basically says, if you say, I mean, this isn't necessarily going to work, the response will be, well, the response I got one time was, well, it works in normal markets. Okay, well, markets aren't always normal. Something goes wrong and suddenly it doesn't work anymore. And in the case of the 2008 crash, the normal markets thing was, well, housing prices always go up. I mean, and people said, well, no, they don't always. And the response was, well, yeah, okay, occasionally in a region they'll go down, but not nationally. And they just shrugged it off. That so that's but there's another thing that I think there's a quote that I've used several times that I think really sums up the problem, and it's a very serious problem, and it's not only even in finance. And the quote is from Lowenstein. Roger Lowenstein wrote I don't know if it was from his book or an article he wrote, but he went to interview at the heart of the failure were these ratings agencies, and they gave AAA ratings to these CDOs, collateralized debt obligations, which were simply packages of enormous numbers, like thousands, hundreds of thousands of mortgages that had been kicked to them by the mortgage brokers whose standards had deteriorated greatly because they could just kick the mortgage. They weren't responsible for collecting the payments anymore. They could just kick it over to Goldman Sachs or a packager who put them all in a CDO. And then they went to the ratings agency to get them to rate it AAA so that they could sell it with a great deal of profit. The ratings agencies gave them triple A's. Now, there are only two things that the ratings agencies had to consider. One was the probability, the average probability that the mortgagors would default, and the other was the correlation between those probabilities. They estimate in Lowenstein's interview, he asked one of the people responsible for this at Moody's, um, why didn't you, I don't know what his question was exactly, but it was essentially, why were these rated so highly? Didn't you know that the probability of default was as high as it was? Because these mortgages were being given to people who just couldn't repay. And the only reason they were repaying was because the price of houses was going up, so they would keep refinancing. Well, the person at Moody's said, based on the data, our job is the statistical analysis of data. And we had to rely on the data, and the data said the default rate is very low. But all they would have had to do is send out some people to take a random sample of people who had taken out mortgages, and they would find out these people, probability they're going to default is not 2%, it's much, much greater. But that was not their job. Their job was the analysis of data. But data is always past data, it's never future data. But they would be violating the requirements of their job if they tried to estimate the future probability that these people would default, because it wouldn't be based on data. It would be based on their impressions going out and interviewing people. So there's too much reliance on past data and too much predicting of future data based on past data, when in fact, the very theory underlying all of MPT assumes that there's no predictability of future data, future prices. Future prices have no future price changes, bear no relationship to past price changes. This is implicit, intrinsic in the theory. So the theory cannot be used to find a way to beat the market.
Yeah, so one thing I want to touch on in interest of time is you had mentioned tax loss harvesting, because that's one thing that a lot of people point to is, oh, you have to do some tax loss harvesting, and you mentioned that this is actually problematic. Can you maybe speak to that a little bit?
Well, the companies that claim that you get a big boost from tax loss harvesting, they simply don't look into the future at all. They just say, okay, you get this, you take this loss, which you suffered anyway. You can't do anything about that, and you sell the security that experienced a loss, and then you take a loss on your taxes, and that gives you uh, an amount of money that you saved by taking the loss. But it's only temporary. You'll gain it back later. If you, what they recommend is you rebuy that security in a month. You can't rebuy it immediately. You rebuy it in a month. Well, if you had it in the first place, you were hoping and expecting that it would go up. Well, if it continues to go up, it'll go up by the amount that of your loss plus whatever else it goes up to. So you're going to have to pay that tax later anyway. So all it does is defer the tax. So you have to make a calculation which gets extremely complicated of what the actual gain from this is over time for your whole life. All they do is calculate the gain that you took immediately that you're going to have to pay back later. So when you do the calculation properly, you find that there is some gain from it on average, but it's not much. It's not as much as you would pay even the robo advisor that claims to do it for you. And then you have to consider that you have to pay your tax accountant to deal with this. And I don't know how much more you might have to pay a tax accountant to report your tax loss harvesting, but it's not zero.
Yeah, you'd mentioned robo advisors as well, and I'm curious your thoughts on this because I know when robo advisors came out, there was a big buzz about it as if, they're this new and different thing, but um, you know, are they? I mean, I never saw the difference that they're any different than what people are doing normally.
Yeah, I agree. Well, they're cheaper than some of the other stuff. Always when you automate something, it's cheaper than if you have a person doing it. But if what the person was doing was worthless, but you can get it cheaper. Well, it's still worthless. I mean, you can go to, you can go to the Vanguard website and buy a total market index fund, and you don't have to pay anything, and it's the best you get. It's likely to be the best result you can get. So it just doesn't, you don't have to pay for this. You pay a very minimal amount. And we didn't talk. We talked before starting this about the Ivy League university endowment funds, and they do the worst possible thing. Harvard, would you believe Harvard pays about $1 billion a year for investment management? They could pay 1/200th as much and get better results. But this this sham of modern portfolio theory and all the math and all the conferences that they get to go to, and the money managers very lavishly buy them dinners and a lot of other things. So it's a good old boys club. It's I call it a conspiracy, and it is a conspiracy, but remember the term conspiracy doesn't mean people getting around in some, darkened room in the basement around a table and plotting. Conspiracy is a word that means breathing together. We just, we do the same thing. We all do the same thing because that's what we do. And we get a lot of money from donors, from tuition payers to pay investment managers to get a result that's worse than we could get by paying almost nothing. Now, this applies to public pension funds in the United States too. It's even worse. Uh, the average taxpayer probably doesn't realize that they're paying $500 a year for worthless investment management of public pension funds. Again, public pension funds in the US, their performance, investment performance, that is, their return on investment, underperforms the the market index by about 1.5% a year, because that's about the amount that they pay for the investment management. So who gets to gets to pay for this worthless service? It's the taxpayers, because that's who pays for public employees' pension funds. And the average taxpayer pays about $500 a year for utterly worthless investment management of public pension funds. So this is the state of the industry. It is indeed a sham.
Yeah. Well, you can add that $500 to the rest of the taxes I pay for inefficient use of taxpayer funds.
Yeah, you can argue about all the other stuff too. I
Yeah.
mean, it's just yeah. I mean, it's everybody picks their poison. This happens to be the one that I know too much about, and it's one that I think is people are monumentally deceived about it.
Yeah.
If you if you asked 100 people, probably only, well, some people I think are getting the message. So this is why index funds have gained. There's been a big movement toward index funds in the last 10, 20 years, which cut the revenues of a lot of these money management firms by quite a bit. And it's individual investors who have realized this more than these so-called supposedly sophisticated investors who run endowment funds.
Yeah. Well, in the interest of time, we got to wrap it up here, Michael. But where can people find more about you?
I'm not much of a I don't market anything, so the I have a LinkedIn profile, so they can look me up on LinkedIn.
Okay.
That's that's the main thing, and they can use Google, of course, and they'll get who knows what. I don't know.
Great. Well, we'll put that in the show notes. But Michael, I really appreciate you sharing your wisdom with us. Thank you again for joining us.
Okay, you're most welcome. Thank you.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, that was a great interview with Michael. Really appreciate him coming on the show. Now we're into the panel portion of the show. We have our very own Barb Freeberg. Hey, Barb.
Hi, Kirk. It is great to be here today.
Well, great to have you as well. It is bumping up against the Memorial Day weekend, so it's only Barb and I. Everyone else is doing something a lot more fun, so good on them, but it'll be just two of us. So, Barb, what were some of your takeaways from the interview?
I loved what he was talking about. It was almost as if he jumped into my mind and answered some questions that I had had for many, many years about things like portfolio optimization, about rebalancing, and about percentages of assets that you want in certain asset classes. And I'm going to dive in here because I have done a lot of these computerized programs where you input the percentages of your portfolio, and they're based on modern portfolio theory, which, just as a refresher for those of you that don't know, that simply says you want to invest in a proportion of stocks and bonds that will give you the best return available for your given risk comfort level. And there's some mathematical calculations that give you or your advisor a curve that'll tell you, okay, you need X percentage in stocks and X percentage in bonds. You'll get the highest projected return based on the amount of risk you're willing to take. Sounds handy dandy. My problem with that forever was, well, it's all based on historical data. And we don't know what the future holds. And so I would do these simulations. I put my portfolio into, and I'm not going to name the tool because it's a really good tool, but I have about, maybe 8-10 different general asset classes in my portfolio, from just a broad-based stock index fund to a small cap to international to bonds to cash to REITs. And I put my portfolio in, asking what is the best asset allocation given the investments that I have, and it would come out with two investments. It would come out with the S&P, the total stock market fund at 90%, and like cash or bonds at 10%. And I'd be like, what? How can that be? That makes no sense to me, given that there are other asset classes that have done very well, maybe not in the past 10 years, but over time, and will serve as kind of ballast for your investment fund. And he helped. I knew it at the time, and it was, well, yeah, because the past 10, 15 years, the US stock market has just trounced all of the other public investments. But that doesn't say it's going to happen in the future. And that's a really big problem when you're crafting a portfolio.
Yeah, it's, you know, this is one of those things that this is, you know, I've got a lot of things that I have problems with Wall Street, and we talk about them a lot in this show. And one of the things is that Wall Street makes assumptions, right? Everyone does, right? If you're doing modeling, if you're predicting any of it, you have to make certain assumptions, right? One assumption is there's gravity. If you throw something up in the air, it's going to fall to the ground. Like, that's an assumption, and it generally holds true, right? But if you think about investing, right, and you're making an assumption, what your brain is actually doing is your brain is shutting off once you make that assumption. So you're assuming that, for example, this is one of my favorites, buy and hold is the best strategy. Once you make that assumption, then you stop thinking about it. Now, the problem with that is, what if it's not true? Well, then you got a big problem. You might say, well, of course it's true. Okay, well, let's go back to 2008. Real estate always goes up. That was an assumption everybody made too. And it caused the whole financial system to implode. You might say, well, that's silly. Of course it doesn't always go up. That's the assumption that everybody collectively made. And they all collectively said, no, we agree. It always goes up. This won't be a problem. I believe even the Federal Reserve made a comment. I forget who specifically made a comment about, well, it's who was it? Who was the Federal Reserve chair at that time? Was it Greenspan or it wasn't Bernanke?
Are you talking about 2008?
2008, yeah. Was it Bernanke or Greenspan?
It was Bernanke.
Bernanke, okay.
Yeah.
So Bernanke came out and said, well, it's contained, right? He said the housing market is fine. It won't be a problem. And so, you know, if you think about that, like, he might have been right, but he was predicting, right? And the prediction was based on real estate always goes up. And it might have been a small bump in the road, but it'll go back up. That's the assumption everybody was making. Now, the problem was not everybody knew what was going on. Hence, if you want more detail, watch the movie The Big Short. It was brilliant. But the point being is, we made those assumptions as a economy that real estate always goes up. The whole world made that assumption because the whole world imploded because of it. People were making bad loans and buying shoddy paper. Anyway, the point being is, when you make an assumption, your brain shuts off. So I'm not saying you shouldn't make assumptions. I can't speak. I'm not saying you shouldn't make assumptions. What I'm saying is that you have to be aware of the assumptions that you're making and always go back and reassess. So for the example of buy and hold, you're assuming that buy and hold is the best strategy. It's not always the best strategy. It's the best strategy in a bull market. It's not the best strategy from 2000 to 2013. It's not the best strategy from the late 60s until 1980. It wasn't the best strategy for that period, or either of those periods. There are periods in time where it's not the best strategy. But people say, well, you know, if it'll eventually come back. Eventually. Note that word, eventually. Because if you had bought in January of 2000, it would have taken you 13 years to break even. You would have lost money for 13 years before you actually started to break even. Eventually, yeah, eventually. Japan, if you had invested in, was it like March or January of 1990, it would have taken 30 some odd years, 35 years, 34, 35 years for the market to actually come back to where it started. Eventually. Do you have 30 plus years to wait? I don't. I want my money compounding every year. But if you've lost that money up front, it's not compounding. And that's the problem, right? Is that we take these assumptions of buy and hold is the best strategy. It'll always come back. I mean, if you're investing in an index, it should, but you can never say for sure, right? And you need to assess your assumption. Now, if you're okay with the assumption, that's fine. That's something that it's a decision you're making and you're okay with that. The problem is people don't think about these assumptions. And that's the point of what we're talking about, is just know the assumption you're making. If you're okay making the assumption, you say, well, afterwards you can say, well, that was stupid. Real estate doesn't always go up. But it's an acknowledgement that you consciously made that decision. You weren't fooled. And that's what Wall Street's good at, is fooling you.
Well, and also all projections are made on past historical data. And of course, that's all we have because nobody knows the future. But it's so important to always leave room, a little bit of room for a question to say, what if history doesn't repeat? Or as Kirk mentioned, what if it takes a heck of a long time to get back to even? Yeah, over, 100, 120 years, stocks have averaged 9%, 10% a year return. But that doesn't count 2000, 2001, 2002. That doesn't count 2008, 2000, whatever the big bear markets were. There were some decades where stocks were flat or fell. And so you can't say that I'm just going to get in, expect a 10% return and la-di-da. And I a lot of times question my own self because I started investing in the 80s and I was conservative. I hadn't read, there was no internet when I started investing. And I didn't know that the theory was that if you're young, if you're in your 20s, you should have 90% of your investments in the stock market because they historically had the best rate of return. Now, I don't know if I would have done that had I known that common belief of today, but I am not the type of person, even today with all my experience and knowledge, that I want to see my entire portfolio go down 30 or 40%. And so throughout my investing life, I've had quite a decent percentage of cash and bonds to stabilize. And what that does is that's going to keep me from getting the top returns over time, but it will also keep my portfolio from the total greatest losses that would be achieved had I been in 100% stock portfolio. So you have to think about your own situation. You have to understand, yeah, this is the history, but we don't know the future. And so you have to kind of do what I call kind of a stress test for your portfolio in the future. Sometimes you can look at, okay, so I have 80% in stocks. Let's say worst case scenario happens and those stocks drop 40%. How am I going to feel? And if you can't handle that, then you need to bulk up your cash or fixed income investments as well.
All right. No, I totally agree, Barb. And well, we got a little surprise guest here. We have Phil Weiss joining us. Little ladies. We were a little miscommunication on the tech. Phil, how you doing?
Good, Kirk. How are you?
Good. Well, glad to have you here. And so Phil, what were some of your takeaways from the interview before we kind of dive back in? Because we wanted to hit a lot of topics today.
So I thought it was kind of interesting because he kind of flies in the face of a lot of the things that we think about as advisors or just in general. I mean, and some of it, the stuff I agree with. Like when I took the CFA curriculum, they talked about modern portfolio theory. I'm not necessarily a fan of it, even though I had to learn it, because it leaves out behavior. And we're not all rational. So the idea that we should kind of disregard it in some ways makes a lot of sense to me. You know, his whole discussion about tax loss harvesting was an interesting one. I mean, I get it because you're kind of taking some of the gains and making bigger gains in the future. But yet, if I can take a stock today that I bought for 100 it's trading at 70. That's a $30 loss if I sell it today. In tax dollars, that's going to give me, let's say if I'm in the 28% bracket, it's going to give me an $840 benefit. I doubt in 1 month that the stock is going to recover and I'm going to give all that up. So why not sell it, take the loss? And if I really like the stock, I can buy it back. So even though I understand that I'm possibly creating larger gains in the future, the value of that loss today to me matters. And so I still think it makes sense to do those things. As far as rebalancing, I get what he says, but if you've never rebalanced, you're going to take on more risk than most of us want to take. Because if I rebalance, I'm trying to reduce risk. That's part of it. It's not all about building the biggest return. To me, I talk to clients about this all the time. It's about building a portfolio that lets you live the life that you want without worrying about what's going to happen and getting in, reacting in fear. And there's a whole cycle of market emotions, right? We buy high, we sell low. So rebalancing helps to control all that. So although I understand some of the things that he said, I don't know that in practice they're going to work for the average person.
Yeah, no, I agree. I think, it's interesting because I love this interview because it talks to a lot of the challenges that we see as professionals, right? And a lot of the challenges we face are, Wall Street has these assumptions like we were talking about earlier, and they don't reassess them, like modern portfolio theory. That's been pretty much disproven in the last, whatever, since 2008. It was pretty obvious. When Daniel Kahneman came out with behavioral economics, it really disrupted a lot of the traditional way people looked at portfolios and economics. Like, oh, the market is always efficient. Everyone has this. I mean, if you think about an academic class, a college class, and I remember taking these classes, like, oh, everyone has the same amount of information at the same time, right? There's no inefficiencies of information, and everyone's making logical choices. No, they're not. Like, no one's making logical choices. Maybe 1 in 1,000 will make a logical choice. Everyone else is run by their emotions. And yet we kind of bake all of our assumptions on these theories: modern portfolio theory, mean variance optimization. You've got all these rebalancing, asset allocation, diversification. They're all based on theories that you could argue or maybe not all of them are true, right? And some, and the problem is, you might say, and I know I'm going to trigger somebody in the audience, at least one person, but I say, of course it's true. But say, well, yeah, because you don't understand, right? And the thing you don't understand is there's a lot of what we call half-truths out there. A half-truth is more dangerous than a truth or a falsehood, because a half-truth sounds true, but it's not completely true. So when you hear something like, diversification is the best strategy to reduce risk, or buy and hold is the best strategy, or low fees are the most important thing, right? That's a half-truth, because I could disprove every single one of those right here, right? Are low fees the most important thing? No, they're not. If I compared an index fund that paid 5 basis points, basically as low as possible, and I compared it to this other fund that was making 100% returns a year, and I had to pay 20% fees to get into that, are low fees the most important thing? Absolutely not. I mean, look at Jim Simons. He was making like 70% returns a year. I'd give that guy 50% of those returns to get those guys. I mean, that's crazy. That's crazy returns, right? Would I be willing to pay half that in fees? Absolutely, I would, right? Because it's not the fee and it's not the return. It's the net return that's important. And so when people talk about these rules of thumb, they don't elaborate on where the pros and cons are and where the little caveats and the carve-outs are, right? Is buy and hold their best strategy? In a bull market, it may be, but not in a bear market. In a bear market, it's a terrible strategy, right? Modern portfolio theory, it doesn't account for a lot of things, right? So, diversification, you could say, is it good or bad? As Phil says, well, if you're in crypto, maybe you don't want to diversify because it keeps going up, right? I'm not saying that that's the best strategy. I'm just using an example. So I think the challenge with a lot of the traditional thinking is that it doesn't think outside the box, and it doesn't reassess these assumptions that we're all making. And because of that, it's actually dangerous. They turn into half-truths. All right, so we're gonna get to Barb here. So Barb, we talked a little bit about before the show the behavioral economics of it all and fees. Kind of how do you look at that? Like, how does that contradict what's going on in Wall Street right now?
Well, I got to jump on you a little bit because you and I actually have had this conversation over and over and over again about fees. And so I want to break that down for us. Yes, if there is a fund that's making, 100% a year, well, then, yeah, I'd pay 40% fees or 20% fees. But the question is, how many funds are out there like that? And so we're looking at rules of thumb for most cases. And I think that's where you've got to, you can't make a case for every single scenario because for every rule, there is going to be an exception. But what the preponderance of research has said about fees in investment funds is, first of all, it is very difficult year in and year out for a fund, an actively managed fund, to beat an index fund. There has just been research, tons of studies that say over longer periods of time, index funds typically beat actively managed funds, usually 70 or 80% of the time. Now you might say, well, let me go in the 20% of the time that the actively managed fund is winning. And I'd say, yeah, go for it. But the problem is that many of those actively managed funds that outperform in 1 or 2 years do not keep it up over time. And the reason that index funds tend to outperform is because in general, you're not paying hardly anything. You're paying from 3 to 10 basis points to buy into that index fund. An actively managed fund who's charging 100 basis points has a tough time after fees delivering a better return. Does that mean you shouldn't? And also there's the other factor, which is a lot of times we don't know the people that are outperforming, because why should they go public? They're making the money. Why should they share their strategies? So there's nuance there. And if you want to try and outperform the market, go for it. But I would say your chances of success year in and year out are slim. And that's not just me talking. That's, a lot of people that are a lot smarter than me who've done a lot of research in peer-reviewed journals.
Yeah, no, I appreciate that, Barb. What about you, Phil? What are your thoughts on that?
I'm more in Barb's camp. When I work with a client, I tell them that I know fees matter and you're paying me to help you with everything that I'm helping you with. So when it comes to the investments that I'm giving you, I'm trying to keep those fees as low as I can, because look, there are people that outperform, but consistency is hard. I mean, let's go back a couple of years and look at Kathy Wood and the ARC funds, right? For at one point in time, they way outperformed the market. Not anymore. And part of the reason that happens, Barbie said, well, there's some people that outperform and they don't want anybody to know. Well, part of the reason not to let anybody know is it gets harder and harder for a strategy to work as it gets bigger. Right? Like if you're investing in small caps, not so easy as you take in more and more money to keep staying true to the strategy, because there aren't that many small caps, or the positions get too big, or you have to put too much money in. So it's not so simple to keep beating the market. You can do it. Look, I listened to Morgan Housel speak recently, and he wrote Psychology of Money, to me, one of the hands down, one of the best books on personal finance that you can read. And he talks about, in the presentation that he gave related to the book, he talked about how, average returns over a period of time lead to spectacular results. Howard Marks has talked about that too. You don't have to be the top performer year after year. If you can just have average performance every year, you're going to beat most investors, because most of us, we sit there and we try to beat the market and we don't do it. And one of the things that I talk to my clients about is, I'm not trying to beat the markets. If I try to beat the market, I'm taking on too much risk. And that's great if I'm right. But in that year or years where I'm wrong, you're going to lose a lot. And then you're going to be really unhappy with me. So it's better off if we sit there and not try to beat the market and just try to generate average returns, because over a long period of time, average returns are going to serve you really well. And you're not going to have that agita that comes from looking and saying, oh my God, my portfolio is down so much, and now I can't do this and I can't do that. So I would rather be like Barb said, let's keep those fees low, because I know Morningstar in particular has published a lot of data on this. There's others too, but fees matter. So I'm really trying to keep those fees low.
Yeah, no, I mean, it makes a lot of sense. And just to be clear, I'm not advocating for higher fees. But what I wanted to point out was, I mean, what both of you are saying is correct. All else being equal, lower fees makes sense, right? If you've got an S&P 500 index versus an active large cap manager, then yeah, it might make sense to index. You know, you shouldn't be comparing the S&P 500 to emerging markets. And if you have a manager that's doing something interesting, and I bring this up and I use the extreme examples of 100% because I really want to prove the point, you know, because if I make an example like, well, the S&P makes 10% and this other thing makes 11, or this other thing makes 15, and you're going to pay, you know, 2.5%, is it worth it? Well, for an extra 2.5%, yeah, I mean, it might be, but it's a little bit more murky, right? And so the idea is, obviously you want to know what you're paying for fees, and you want to reduce that in any part of your life. But I would also argue that people lose more in bad decisions than they do in fees, right? If you're selling at the low and buying at the high, or you're chasing stupid investments, you know, or you're investing in things that you heard about at the country club or whatever, like things that aren't really a strategy, it's just more gambling. I would argue people lose more in that than fees, just because it's just our nature to want to chase things, as Phil and Barb says, like as Phil says, like just average investing, like we'll be fine. And you're probably right, but that's boring. Who wants to invest in boring? Come on, I want to talk about it at the cocktail party. I want to brag about it at Christmas. I don't want to be boring, right? But boring works, right? Buying a house that you've lived in for 30 years that's gone from 50,000 up to $500,000. Yeah, that's boring. That's a lot of money though. It's boring, but hey, it works, right? So I think it's just important to I always like to bring up the other side of things, because I think that people they're making assumptions that they don't realize they're making, and they're not testing their assumptions. And that's a lot of what we try to do in the show. Now, you know, one of the things that Michael talked about were pension funds. And here's another area that, you know, I find interesting. But if you look at pension funds and endowments and these large institutional money managers, they pay these money managers a lot of money. And what are they really doing? Like, is it worth it? And, you know, is what they're doing actually worth the fees you're paying? So I don't know, Barb, what are your thoughts?
I don't know. Okay, but I do know that the trend for pension funds has gone a lot into private investing. And there's this whole mystique around private investing. You hear about the angel investors and the venture investors, and they get in on these startups, and then they have the chance to compound, you know, thousands and thousands of times. But what's not stated is the risk you are taking going down that path. Because of every 10 private investments or startup companies or riskier non-SEC regulated firms, usually one or two might make it and the rest won't. So you are going to need a home run times 10 to really be successful with these strategies. Now, I'm not saying they're no good. I'm not saying don't get into private investments, but you don't have to if you don't want to. Because as Phil has said, as the data shows, a boring just invest, 10, 15% of your income every year in a diversified portfolio of stocks, bonds, US, international, and over 40 years, your portfolio is going to grow 10 times. Okay? That means, $1,000 is worth $10,000. $100,000 is worth $1 million. So a little patience and a very consistent, boring strategy has shown to be true. And again, I'm not going to say this is guaranteed for the future, but there's a lot more risk and a lot more uncertainty in these pension funds. Look, it's beyond my pay grade. So do I think that that has implications for individual investors? Not really.
Yeah, no, appreciate that, Barb. Phil, what about you? What are your thoughts?
So I'm going to add one other thing that's we didn't talk about too, is that when I talk to people, one of the things I tell them, we talked about behavior and investing, all that. I think I can add more value with good tax planning layered into all your investing. Like that's something that we really miss when it comes to how we invest, is it's not what we pay in any one year. It's looking at the big picture and thinking about your lifetime tax liability. That's why things like Roth conversions and things like that matter, because I can control what tax I pay on my investments. And that can add so much more value than finding another 1% or 2% in returns. Tax value, look at the studies that talk about it. That's where you can really add value. As far as pension funds, I mean, I'm not an expert on pension funds. I know I've looked at them. One thing I will say about them is that, they're typically underfunded. So if they're underfunded, either their assumptions are way off or the investments that they're making are way off. How many times you hear about these underfunded pension funds? You don't hear about a lot that are overfunded. They're usually underfunded, which means it's something, they're trying to chase returns is my guess. And if they're chasing returns, they're not getting what they're looking for because they're underfunded. They have underfunded accounts.
Yeah, I mean, let's talk about that for a second, Phil, the underfunded pensions, because we had Rob Arnott on a few years ago, and it was great. He wrote a great piece on the state of the pension world, and the state of the pension world is basically a disaster. I researched the state of Massachusetts and all the town state pensions, and I think there were like two pensions that were like 95 or 98% funded. One of them was Massport, which is where all the politicians go when they retire. Wow, that's overfunded. I think another one was like the Boston Teachers Union or something like that. But everything else was underfunded. And there were some that, well, why don't you talk about it? I'm just curious on your thoughts on it, because I can certainly talk about it. I think it's a fascinating topic, but you talk about how it gets underfunded and all that.
Yeah, I mean, if I think about it from an accounting perspective, a pension fund has certain returns that they're expecting from equities. They have certain returns that they're expecting from the fixed income investments, and that gives them what their target return is. And if they don't hit those targets, and so they collect and they put money into the fund to achieve their desired objective. They have calculations on how much they're going to pay out and everything like that, and then they don't achieve the returns that they expect, and so they end up underfunded. And public pensions, that's a big thing, right? Why do you think we moved to 401ks? That's got to be one of the main drivers that we moved to 401ks, because it took the risk away from the company and put it on us as the individuals. Because now we went from defined benefit, where you know what you're going to get, to defined contribution, right? So the companies are willing to give you that 401k match, and I'm not knocking it. It's great that we get that, but they give you a 401k match. They don't guarantee what you're going to get on the other end anymore. They guarantee what you're going to put in, and now it's up to you to do that. But if they were doing a better job, I don't think we would have to have 401ks, because part of the reason to me that we switched to that system was because it took the onus off the companies to make sure that they had enough in their pension accounts to pay the beneficiaries.
Yeah, it's interesting. I mean, when you see, what I find interesting is if you actually look at pensions, there's two parts of it. One is the rate of return, And well, actually, there's a few parts. The rate of return, right? And then there's the withdrawal rate, like how much is being withdrawn when, and how much is being put in. And if you look at some of these pensions, and I highly recommend you go to go to the website for your state and just kind of look these up. And what you'll find is there's certain states that are a disaster. Illinois, Connecticut, and I think Tennessee is another one that's a disaster. But one of the fascinating things I saw was I went through my state's pensions. If you look at like state of Massachusetts, like different towns had different pensions, and different towns had certain assumptions of rate of return. Some towns had the assumption of 4%, some had like 10%. And the 10% made the pension look solvent. It made it look like it was funded correctly. But if you actually put a more realistic number, like maybe 6%, it was drastically underfunded. So the website I saw actually listed them all and it showed like rates of return, showed underfunded, overfunded percentage, like it had all the data. I was looking at this and it was just so obvious that like, and I won't name the town, but there's a town around here that was one of the best in terms of, you know, over underfunded. Like the percentage funded was the best, but also they had the highest return assumption by a lot. And if you actually reverse the numbers, you'd realize it was a mess. So I think the challenge that I see is that a lot of these pensions are making assumptions to not look bad. But what happens if we go into recession? What happens if we have another 2013, where you lose 13 years of compounding? That's a problem with pensions. And what happens when, you know, because we're eventually going to have a recession, unless we turn into a banana republic or Zimbabwe, which, you know, we're on that track at the moment. But it does raise the question of what's going to happen to pensions if we get there, because a lot of them are already underfunded. Like Illinois is like 30% or 25% funded. I mean, there comes a point, and I don't know where that point is, where it's unsavable unless you have massive returns for long periods of time. There is a point where it's completely unsavable. And I think Illinois is at that place. And I have to go back and listen to the interview where that place is. Maybe it's 60, 70%, somewhere in there. Maybe it's lower, but Illinois is way past that. And there's nothing you could do to save it other than print money and file for bankruptcy, like the state would have to. So it raises an important question for people who have pensions, right? Have you looked at it and is it safe? And how are they making those assumptions? And if you're in a private company pension, it might be okay. You want to ask, you want to find out. Like there aren't many around anymore, but there are some. And most companies have stopped allowing new people to be a part of it. But there's some companies out there. I think like Raytheon has a pension still, and I don't know. That's the only one I know offhand. But there's other companies that have them, and just check, just go and look and see, is this a solvent pension or not? And anyway, so Barb, final thoughts from you.
Two final thoughts. One, your conversation about the pension really underscores advice for all investors, which is don't depend on just one source of income for your retirement, because the future is unknowable. And so the more diversified that you are, especially within retirement, the more cushion you have should one of those sources of income dry up or not provide the returns that you expected. I can't tell you how many Uber drivers I have who are retired engineers and, you know, retired this, retired that. They're making cash flow in retirement. And then you've got, you know, sure, Social Security's great until it isn't. You know, I don't see it failing, but never say never. So it's not a bad idea to have an investment portfolio, to look at other sources of income, to have a diversified portfolio and pension income in retirement. So on to one other issue before I sign off, which is rebalancing. And as Phil said earlier in the session, rebalancing is a strategy not to increase your returns. It is a strategy to keep your risk level. And risk, when we say risk, that means the volatility, the ups and downs in the portfolio value within a certain band. And there is data, again, from the AAII, American Association of Individual Investors, which has shown if you choose not to rebalance, your stock market will become a greater percentage of your overall investment portfolio, and your returns will be greater. But your portfolio will also be a lot more volatile. So that is the reason to rebalance. So I am Barbara Friedberg. You can find me at Barbara Friedberg Personal Finance and on YouTube. See you next time.
Great. Thanks, Barb. And Phil, final thoughts from you.
So, a couple things. One, diversification. There's lots of different types of diversification to think about. And this as I'm thinking about our discussion, it's reminding me of the one that we often don't think about, that Barb kind of alluded to in what she just said. It's not just diversification of assets. It's diversification of account types or diversification of income sources, however you want to call it, right? Because everything gets taxed differently. I want to have money in an IRA, but now how is that taxed? It's taxed as ordinary income. I have my Social Security. Well, for most people, 85% of that's going to be taxed. I can have a Roth IRA. Money that's in my Roth doesn't get taxed. I can have an HSA. That also doesn't get taxed. I have interest and dividends and capital gains. Under the current system, those are taxed at lower rates. If I'm trying to manage how my income comes in and how much I have, if I can manage these different buckets that I can pull from, it can help me manage my tax rate better. Because isn't it better to look? I'm not telling anybody to cheat on their taxes. I'd never do that, right? I'm a CPA. I'd get in a lot of trouble if I did that. But I am telling you, pay just your fair share. And part of managing your portfolio is positioning it so you only pay your fair share. So think about having these different buckets to pull from. It's another type of diversification, and it gets into, instead of asset allocation, it gets into asset location. And that matters too. Rebalancing, we have two big risks as investors to me. One is longevity risk, that we outlive our money, right? And two is sequence of returns risk, because we know, as Kirk said, at some point, I expect we're going to have a recession. We have a recession, going to lead to a bad market, but we don't know when that's going to happen. So we want to do things. Rebalancing helps to protect us against longevity risk, against sequence of returns risk. So we want to make sure that we do those things, because you don't want to have your portfolio cause you agita and cause you anxiety and anything else. You want to be able to just live your life and do the things that you want. As for me, I know that experiencing big life transitions can be stressful, and my job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. If you'd like to learn more about us, you can download our free ebook, How to Flourish Through Life's Big Changes, at apprisewealth.com/ebook, and you can also sign up for our blog. Thanks for having me today, Kirk.
Right. Thanks for coming on, Phil. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.